Welcome back to the channel, everyone! In today's video, we're diving deep into dividend policy, one of the most important decisions a company makes and one of the most misunderstood topics in finance. This is a two-part series, and today we'll cover both parts, so grab your notebook, hit the like button, and let's begin. This is Part 1, Section 1. What is dividend policy? So first things first, what exactly is dividend policy? Dividend policy is the company's approach to deciding how much profit to distribute to shareholders as dividends and how much to retain and reinvest back into the business. Every company earns profit. Now the big question is, should they give it away, keep it, or do a mix of both? This decision influences shareholder satisfaction, stock price stability, company growth, market perception. A good dividend policy strikes a balance between rewarding shareholders now and ensuring the company grows later. Section 2. Why dividend policy matters. Dividend policy isn't just about cash payments, it's about communication. A company's dividend decisions send powerful signals to the market. Here's why it matters. 1. Investor attraction. Investors have preferences. Income-seeking investors prefer stable, regular dividends. Growth-oriented investors prefer retained earnings. 2. Market signaling. If a company raises dividends, investors often assume profits will continue to grow. If dividends are cut, it may signal financial trouble. 3. Stabilizing share price. Regular dividends reduce uncertainty. Stability equals confidence. 4. Capital allocation discipline. Management must be careful when distributing cash. It forces better planning. So dividend policy is not just financial, it's psychological, strategic, and reputational. Section 3. Types of dividends. Before understanding policy, let's clarify the types of dividends companies can pay. 1. Cash dividend. The most common, shareholders get cash. 2. Stock dividend. Instead of cash, shareholders receive additional shares. 3. Special or extra dividend. A one-time bonus dividend, usually when the company has surplus cash. 4. Interim and final dividends. Interim, during the year. Final, at year-end. 5. Scrip or promissory note dividend. A promise to pay later, used when cash is low. 6. Liquidating dividend. Paid when the company is partially or fully winding up. These set the stage for understanding dividend policy. Section 4. Forms of dividend policy. Here are the main types of dividend policies companies use. 1. Constant dividend per share policy. The company pays a fixed amount per share consistently. Predictable, great for income investors. If earnings fall, the company still tries not to cut dividends. 2. Constant payout ratio policy. The company pays a fixed percentage of earnings as dividends. When profits go up, gives dividends go up. When profits fall, gives dividends fall. More volatile for investors. 3. Residual dividend policy. Company follows this logic. 1. Fund all profitable investments first. 2. Whatever cash remains gives dividends. This is more common in high-growth firms, especially tech companies. 4. Stable or regular dividend policy. This policy keeps dividends steady, with occasional increases. It's the most investor-friendly and most widely used. 5. No dividend policy. Companies reinvest everything. This is common in startups, high-growth companies, firms needing large R&D budgets. Examples historically include Amazon, Tesla for many years, and Google. These 5 categories form the backbone of corporate dividend decisions. Section 5. Dividend policy theories. Now let's get into the theories, the intellectual foundation of how economists view dividends. No formulas, just clear concepts. 1. The Irrelevance Theory. Modigliani and Miller. M&M say, dividends don't matter. Shareholders care about total wealth, not how it's divided. If a company doesn't pay dividends, investors can sell shares to create homemade dividends. This works only under perfect conditions. No taxes, no transaction costs, efficient markets. In the real world, these conditions don't hold, but the theory is important. 2. Bird-in-hand theory. Gordon and Lintner. This theory says investors prefer certain dividends today over uncertain capital gains tomorrow. Better a bird in the hand than two in the bush. So companies paying higher dividends may have a higher stock price because investors value certainty. 3. Tax preference theory. Investors might prefer lower dividends because dividends may be taxed more, capital gains can be deferred or taxed lower. So investors might like companies that retain earnings. 4. Signaling theory. Dividends send messages. Increasing dividends equals we expect future earnings to be strong. Cutting dividends equals we're struggling. Market reacts strongly to dividend changes because of the information they signal. 5. Clientele effect. Different investors prefer different policies. Retirees give stable, regular dividends. Young investors gives growth, no dividends. Companies attract the clientele that matches their policy. These theories explain investor behavior and corporate decisions, even though no single theory fits all situations. So to wrap up part 1, if you enjoyed this breakdown of dividend policy, hit like, drop a comment telling me your favorite dividend-paying stock, and share this video with fellow learners. This is part 2 of our deep dive into dividend policy. Let's jump in. Section 1. Factors affecting dividend policy. Dividend policy isn't chosen randomly. Companies analyze several strategic, financial, and environmental factors before deciding how much to pay. Let's break them down. 1. Earnings stability. Companies with stable profits are more comfortable paying regular dividends. Examples: utilities, consumer staples. Unstable earnings gives lower or irregular dividends. 2. Liquidity position. A company may have high accounting profits, but low actual cash. Dividends require cash in hand, so liquidity strongly affects payments. 3. Future investment opportunities. High-growth firms prefer retaining earnings to fund expansion, R&D, new markets. Tech companies often pay no dividends because opportunities are abundant. 4. Debt obligations. If a company is heavily leveraged, it must pay interest, maintain required ratios, meet lender restrictions. This limits dividends. 5. Tax considerations. Dividend taxes vary from country to country. If dividends are taxed heavily, companies may prefer low dividends. If favorable tax treatment exists, companies may increase payouts. 6. Legal restrictions. Certain laws restrict paying dividends when profits are insufficient. Capital would fall below minimum levels. The company is losing money. Legal compliance is non-negotiable. 7. Control considerations. If companies issue new shares to raise funds, existing owners may lose control. To avoid losing control, they may retain earnings instead of issuing new equity, reducing dividends. 8. Inflation and economic conditions. In times of recession, companies conserve cash. In booming markets, companies may distribute more. 9. Shareholder preferences. Clientele effect. Some investors want steady income gives prefer stable dividends. Others want capital gain gives prefer reinvestment. Companies try to satisfy their dominant investor group. 10. Management philosophy. Some CEOs are conservative. Others are aggressive with payouts. Management personality plays a surprisingly big role. Section 2. How companies actually decide dividends. Let's take a practical look at how boards and management teams actually decide dividend payouts. Step 1. Evaluate annual profits. Check operational performance. Step 2. Review cash flow. Even profitable businesses may lack cash. Step 3. Assess future needs. Investment plans. New factories, research, marketing take priority. Step 4. Maintain stable dividends. Companies prefer not to cut dividends. They aim for consistency, even if it means small increases. Step 5. Analyze competitors. If similar companies pay dividends, shareholders expect the same. Step 6. See present recommendation to the board. Management proposes the payout. Board approves or revises. Step 7. Announcement and market reaction. Dividend announcements influence stock prices. This process repeats every quarter or annually depending on the company. Section 3. Types of real-world dividend policies with examples. Let's see how companies apply dividend policies in real life. 1. Stable dividend payers. Coca-Cola, Johnson & Johnson, Procter & Gamble. These companies increase dividends slowly, but consistently. 2. No dividend growth companies. Amazon for many years, Alphabet, Google. Meta before it started dividends. These firms focus on reinvestment. 3. High dividend payers. Telecom companies, REITs, utility companies. They often generate strong cash flow, but have limited expansion opportunities. 4. Cyclical dividends. Mining companies, oil and gas companies. Dividends rise and fall with commodity prices. 5. Specially bonus dividenders. Apple, Microsoft, and some Asian companies periodically issue special dividends when cash reserves are huge. Section 4. High dividends versus low dividends. Should a company pay high dividends or low dividends? Let's break down both sides. High dividend policy. Advantages. Attracts income-focused investors, signals strength and confidence. Creates a stable shareholder base, boosts stock price in many cases. Disadvantages. Less money retained for growth, risk of dividend cuts in tough years. Can increase leverage if company borrows to maintain payouts. Low OR. No dividend policy. Advantages. More funds for expansion and innovation. Lower risk during downturns, preferred by growth investors. Disadvantages. Income investors may avoid the stock. Stock price may remain undervalued. Company must justify reinvestment returns. Section 5. How investors should evaluate dividend policy. Now the important question. What does dividend policy mean for you? Here's how investors should evaluate a dividend-paying company. 1. Dividend stability greater than. High dividend. A stable dividend is better than a high one that may be cut. 2. Check payout ratio. Even without math, high ratio gives risky. Moderate ratio gives sustainable, low ratio gives room for growth. 3. Look at cash flow, not just profits. Cash flow drives dividends. 4. Compare with competitors. If peers pay dividends and a company doesn't, gives red flag. 5. Identify your type. Ask yourself, do I want income or long-term capital growth? Your preference determines which companies fit you. 6. Avoid chasing high-yield traps. Sometimes high dividends signal financial trouble. Let's wrap up our dividend policy series. Thanks for watching both part. If this series helped you understand dividend policy, hit the like button, subscribe, and comment which topic you want next. See you in the next video.